Welcome to the RJLT Economics. In this podcast, I want to discuss a very interesting topic, which is the battle of bubbles. Namely the bubble, the everything bubble in the US-led Western liberal democracies and China's housing bubble. These bubbles are some of the largest in fact, I would say they are the largest and the second largest in the entire history of finance. And the way that I'm seeing it, I think both of them are either already collapsing or, let's say, already slipping into the final collapse. And in this podcast, I want to discuss this issue. I want to first lay out the structure of these bubbles. And then I want to talk about how I see the resolutions of these bubbles, how namely the people in charge would act as the bubble really goes to pop. Before I start, I want to say that obviously I haven't been posting anything, in fact, in the last month or so, mostly because I've been trying to, actually I joined a new project, so I was been working on a project, and at the same time I've been trying to sell my car because I'm planning to leave France, because I think probably it's best that I leave this year. So there are many things happening and I really didn't I was too lazy. Perhaps that's the best explanation. But anyway, let's move on to this part, the first part of today's podcast. First, let's discuss very briefly. Let me talk about the everything bubble in the United States. The source of this bubble is very simple, which is that the Federal Reserve, perhaps in collaboration with the US government, or perhaps under the coercion of the US government, or perhaps incentivized by the political and economic environment in the United States, which essentially the political system also, the political class are also sharing the same circumstances. Under these conditions, they have printed up a bunch of money. Ostensibly, this is to avoid a recession. And the idea is that, and in fact, they are not really hiding it, right? They have been saying, I think some of the central bankers in the United States have proclaimed that recessions were a thing of the past. Perhaps it was the English. I don't quite remember who said it, but someone said that we knew macroeconomics so well that recession was a thing of the past. And I think this was said before the housing bubble in 2008 burst, right? But afterwards, they learned more lessons, and this time they learned the lesson. Ben Bernanke, I clearly remember a decade ago, the guy went on a lot of media and said essentially something to the effect that he said, of obviously being humble gentleman, he said that he may not be the cleverest economist out there, but he wants to think himself as a good student of the Great Depression. And the lesson that he picked up from the Great Depression is that if the United States just printed up a bunch of money, there would not have been a Great Depression, and the recession could have been reverted very quickly. And that is exactly what he did. And to his credit, and to the amazement of a lot of the critics of the idea of quote-unquote quantitative easing or modern monetary theory, this gig just carried on for over a decade. It was 12 years, more than 12 years, and things seem to just seems to to be just going fine. It seemed as if that this could just go on forever, and just when the maximum complacency was reached, when the asset prices inflated at the fastest speed, highest speed in record in 2021, that was when we peaked, right? And this year we see that basically perhaps partly triggered by inflation, and this was perhaps could be ascribed to the fiscal policies of the Big D administration or regime, which basically they printed up a lot of money, they gave it to people who are not working, and they did not allow people to work in the United States, and this triggered a range of imbalances in the productive part of the economy, right? Think of the everything bubble. That was printing money, going and sending that money to the asset market, to the housing market, to the stock market, to the bond market, and to all the collectibles and cryptocurrencies. But that money didn't necessarily go to the productive sectors. But now this money actually are going to the productive sectors. In terms of consumption, where at the same time people were not allowed to work. So there is an imbalance, a more exacerbated imbalance in supply and demand, and this triggered inflation. And as this inflation really started to speed up and pick up pace, it became the expectation of interest rate adjustments became something that hung on the on the neck of the asset prices or whatever. But this expectation already triggered a round of decline in asset prices, particularly in the highest risk ones. And then, of course, when the war started, when a range of ridiculous policies were implemented, and when faced with increasing inflation, the Federal Reserve had no choice but to protect the US currency, the US dollar. We see really a collapse in asset prices in some of the higher risk markets. Right, first to collapse obviously is the cryptocurrencies. These are the highest risk assets. They are also the class of assets where the highest margins have been used, and this obviously is why the collapse is the quickest. And when this collapses, obviously we know that the stock market is not far behind, and in this case it really is collapsing at this. It has been collapsing at the same pace. No, maybe not same pace, but the same tempo. Let's say. I think in the last 14 weeks, counting this week, perhaps there are maybe just 1 week or 2 weeks that were green. This is setting a record. So in the stock market in the United States, and obviously this does not look like it's the bottom, because we're still seeing some after this prolonged decline. We're seeing some bounces, and the volatility is still there. That basically means that some of the shorts were covering, and that some people for example, Kathy Wood and her ilk are still hoping for a V-shaped recovery or some W-shaped recovery or whatever shaped recovery, and that basically is the stock market. The bonds market, I think the yields are widening, and there are some signs that it's going to go risky. Let's say it's just I think there is severe risk there, and that is where I think the most important part of the financial system in the United States. The stocks can collapse. It doesn't really matter that much. Of course, there are a lot of institutional investors, and it does matter for people's retirement, but doesn't matter as much because as the bond market, because if the bond market collapses, the economy simply comes to a halt, because the economy in all major economies today are run on debt, and the bond market is how a lot of the companies finance their operations. When that is it collapses, basically companies will not be able to, a lot of companies will have to shut down, and this will have a knock-on effect on the real economy. That is really much more severe. And finally, when the bond market collapses, it will be the real estate market that will also collapse. And when the real estate collapses, I think it's different than stock market or bond market, which can hold. I think when real estate, my understanding is that most people who own properties are not so prepared to sell their properties because the prices are coming down. They will have to sell when they come into financial difficulties and the price is coming down. And so that means that when we reach that point, there will be a flash sale, and it will be a crash in the in the real estate market, in the housing market, and that would mark the bottom. When it comes to China, it's much simpler. China has, for the last 2 decades, and particularly in the last decade, been trying to really invest in technology, in intellectual properties. It wants to gain control of key technologies in chip design, right, in telecommunications, also in life sciences, I think in agriculture, in renewable energies, and all these things, space, aerospace. It wants to have these technologies. And this is obviously, I think every country at a certain point wants to be in charge of its destiny, right? So that's it's understandable. But the way that the Chinese government have gone about doing this was to again print a bunch of money and basically have a very loose monetary policy. What has happened is that because there aren't so many profitable projects, and because local governments tend to find that developing residential housing is a way to get very quick GDP growth. A lot of this money that's been printed up actually went to the housing market. So there are some statistics. I don't know exactly which is correct, but some people say that Chinese residents are now some of the most leveraged people in the world. comparable to the Americans, but whereas the Americans have spent the money on goods and services and also on their housing, the Chinese spent all their money and borrowed up all that money to buy a pigeonhole in a high-rise apartment building, which inevitably in 2 to 3 decades will become slums. And I think in 4 to 5 decades will probably collapse. That's my opinion. So this has continued for at least, I would say, a decade. Some people may say that they're close to 2 decades. And this has basically grown to the largest bubble of all time. Of course, if we consider America's everything bubble and we take the crypto bubble, the stock bubble, the bond bubble, the real estate bubble in the United States all together, then it's a bigger bubble than China's housing bubble. But if we compare America's housing bubble with China's housing bubble, China has a bigger housing bubble, right? If we compare America's stock bubble with China's housing bubble, probably China's housing bubble is bigger. So that's the scale. Right, so right now, because economic growth has slowed, and surprisingly because people don't have money to spend on consumption. So a lot of the companies in manufacturing, in services, they actually have made some progress. They are now producing much better products than they were 1 or 2 decades ago. And they're providing quite good services, quite good tech products compared to before. And sometimes the tech products are really, I would say, actually leading world class in quality. But the people just don't have enough money to consume on these goods and services because they have 30 years mortgage payments, and each month they have to take half of their after-tax pay to pay that mortgage. And so the disposable income after food and energy cost it's minimal, right? Perhaps I would say this is a wild guess, but I think average disposable income per capita is less than $100 per month. So that is not sufficient to support a economy, especially an economy that wants to focus on technology, on high-end services. That simply isn't possible. So that is the problem that China is facing. So that's basically laying out the issue. Let's talk about now how I see the bubbles would unwind. I think for the United States, the question would eventually come down to should the government and the Federal Reserve, the deep state, protect the asset bubbles, protect the asset classes, protect the rich essentially, or should they protect the currency, protect America's hegemony? I think the rational ones would protect America's hegemony, and America's stranglehold on the world economy remains the US dollar. And it is not US military, because America can fund its military only because it has the US dollar. Without the US dollar, the US military will be defeated very quickly, very easily, because its equipment, though very expensive and extremely advanced, are very expensive to operate and more expensive to replenish. When there is not enough funds, insufficient funds to do so, the military cannot operate and the losses cannot be made up. So America's military power is secondary to America's monetary power. It's not even its economic power, because insofar as America has the world's reserve currency, it can fund its military. And insofar as America can fund its military, its military can be used to protect the reserve currency status of the US dollar. But that is contingent on that United States does not itself undermine its reserve currency status. If the United States goes into hyperinflation, then there is no military that can save the economy from that can save the dollar, right? Basically, that's, in other words, let me just put it more directly, because I think I've been talking a lot, but not really touching the real sense. The real sense is very simple. The United States military can go to a third world country and force that country to use the dollar. But if the US dollar collapses, if the US dollar goes into hyperinflation, it basically becomes worthless anyway. And even the Americans won't be using it. And at that point, the military cannot really do anything. So that's basically what I want to say. So I think eventually they will protect the currency. And this, going back to how I see the collapse will happen, means that I think at that point, the cryptocurrencies already bottomed. The stock market probably is close to the bottom, but not necessarily so. The bond market will be hanging on the last thread. And as America really commits to protecting its currency, which at that point perhaps means a full percentage point, 2 percentage point rate hikes, and some perhaps Jerome Powell comes out and says that the Federal Reserve is absolutely committed to fighting inflation, and perhaps at that point that will not be the Biden administration, but some other administration will come out and say that America will not default on its obligations. Saying these things, perhaps that would signal America's commitment to its currency, and that would, I think, cause a default in the bond, not a collapse in the bond market, perhaps. Mostly the corporate bonds. I think the US government is able to still fund its debt, but a lot of companies will go in trouble, and this really is going to be carnage. But as I would like to say, because the American economy remains one that is very dynamic, I think recovery is still possible and in fact feasible after a collapse. It almost always comes back. So that's the American situation. About the Chinese situation, I think it comes down eventually to the question of should those in power protect their own wealth, or should they protect their own power? I think they will protect their own power. They will protect the stability of the country, because without I think perhaps America has reaffirmed them, reassured them that it is important for them to protect their power. In the past, you see, there was this guy, a former Chinese leader, who said that we should let part of the population to get rich first, right? And then, of course, we can send these population to Canada, America, and then, of course, this guy sent his children to the United States. All of them in America. All of them went to, I think Harvard or Yale or whatever, these guys, right? But now what America has shown these people is that their properties can be seized, their wealth can be confiscated, simply because they are from a, let's say, unfriendly regime, right? So this tells them that the old thinking of making a bunch of money from their own country, sending their children to, let's say, the West, and migrating, getting some green card in those countries, and migrating to those countries is no longer really a realistic path forward. Going forward, to ensure their quality of life after retirement, they can't rely on retirement in Canada, in Vancouver, or in Boston, or in San Francisco, in Los Angeles, but instead they have to make do with mainland China, and that means that they will protect their power. And I think that means that they will let the housing bubble, real estate bubble, to pop. That will have a knock-on effect on the upstream suppliers, and that is a major part of China's economy now, perhaps a quarter of China's economy. But it is what it is. And I think for the long term, it's actually a good thing, because these people who are exceptionally rich, who are very powerful, they control China's fate, but at the same time they have to build up their own country now, because they can't go abroad and bring their money there. So this means that China's development could be better. I think eventually, with this housing collapse and with the reallocation of financial resources to more productive sectors of the economy, I think overall I'm quite positive on China's mid to long-term economic development. Or maybe mid-term, let's not say long-term, because there's always currency and political risks when we talk about China. I'm from China, so I understand that it is very important when dealing with China to be cognizant of the currency and political risks. But of course, if you are really an international businessman or international investor, you should also be quite cognizant of the currency and political risks in the Western economies, chiefly in the United States, with all these regulations, what's that name? But anyway, all the anti-terrorist, anti-money laundering, all that stuff makes it very, 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 very tricky to do business with America. So that is a risk, and of course you don't know when your business partners or your financial entities, your subsidiaries, will be sanctioned by the regime there. And of course, de-dollarization is really a thing, and there are major economies in the world today committed to the cause, to the task of de-dollarization. So there is also negligible currency risk. Although, as I have mentioned, I think 2 months ago, perhaps, in one of my previous podcasts, I do think that compared to the Japanese yen, the British pound, and the euro, the US dollar is a stronger choice, and the Federal Reserve has this ultimate, I don't know if it's perhaps, what is it called? What is that card? Joker card? No, it's not Joker card, but this card, well, it has this, I don't know, respawn card or whatever. Basically a second life, right? It has a second life. By sacrificing the euro, the British pound, and the Japanese yen, it can suck the financial resources from these economies back to the United States, and thereby mitigate the impact of the recession and have a better control of its currency. Indeed, it has been said by some, and I kind of agree, not fully, that it is possible for America to have control of its inflation problem, with an interest rate, with the Fed funds rate actually lower than the inflation numbers. It is possible if there is an inflow of financial resources from countries that America is sacrificing, its allies. All right, so this is my podcast for today. I think I will process, I'm actually recording it on Tuesday, but I think I will probably process and then upload it on Wednesday. Anyway, thank you very much for listening, and have a great day.